Live streaming is on.
All right. Good afternoon, everybody. Event Trader here. Being joined, of course, by none other than Brett Manning, chart trader. Brett, how are you doing today?
I'm doing pretty good. Gavin, how are you?
Doing good, doing good. I'll tell you what, before we get into this, Brett, let's take a quick look at the markets because some interesting price action going on here as we're slipping down and really giving up all that early gain here back down to the 39.75 level. So I know you religiously repeat to people that it generally takes about 24 to 48 hours to get kind of a true understanding of market price action and how they are digesting the Fed. So
Mm-hmm.
we're going to get deeper into the Fed here, and we're going to get deeper into some of the reason behind it. But let's just talk about the last 24 hours and kind of your thoughts about what we're seeing right now, and if you're overly concerned. So obviously the initial reaction seemed to be somewhat positive going up with what Powell had to say. Some changes to the language and the terminal rate standing still, and the
Mm-hmm.
idea that we're closer to peak rates helped provide a boost. Then we started rolling over on the call. We'll get into a little bit deeper on that. Some missteps by Powell and Yellen commentary coming at the same time. I don't know why they decided to run Yellen and Powell at the same time, given current events, but they did, and both of them had some serious miscues right at pretty much the same moment, which led to
Yeah.
some selling. But then we got that early buy. We saw support hold up overnight, and then we got that early buy. Now we've pretty much given up all those gains. So, quick take, and again, we're going to be getting deeper into it. What's your take of the last 24 hours of trade here?
Well, yeah, I think that you and I talked about this yesterday. The Yellen thing was really probably the biggest driver because it's such a head fake, right? We're
Right.
like, we're gonna backstop everything, and then we're not gonna backstop everything, without any sort of like acknowledgement that that was a 180 on something that had been very clearly kind of presented to the world and had obviously had an enormous impact on how people were trading the banks. And you can see it showing up right now. I mean, the market was holding up today, and the regional banks started to gradually deteriorate. Now the KRE is down almost 3%. And I think it's just kind of, you know, people are starting to get that nervy feeling again.
Yeah, it certainly seems that way for sure. So, again, we'll be monitoring this price action. You got any levels on your charts that you're watching here, Brett, for support? Certainly, the overnight low. Actually, it wasn't the overnight low. It was basically the late afternoon close yesterday around 39.66. I got that level on there, about 11
Yeah,
points
we're
away.
right about there.
Anything on your chart that you're watching here?
Well, I mean, the level that had been so powerful in terms of dividing the world was 39.50 in the continuous contract for we had for a good 7 or 8 sessions. So, that's right where that 200-day comes through and flat. And we just kind of been boxing around that for a while. Then we started to rally, and now we're turning back down. And this is kind of like yesterday wasn't really a candle wick or tail. But there's a little bit of a similar feeling when I use that term "eat the tail," in terms of we have the rally this morning, and there's one direction of it which is getting anywhere near yesterday's highs. You can kind of see a lot of short stops being hit, but then the same thing happens in reverse when you start to eat back down into that morning rally. There's a point where it turns from being a pullback in the context of that rally to starting to kind of flip through and become this looming kind of gravestone doji sort of pattern bar, which is coming into place right now. And in this sequence, just purely from a technical pattern read standpoint, it's a bad place to see that bar. I mean, it's kind of like, it puts a little bit of a gravestone on top of that rally, um, right off of that 50-day moving average in the S&P. And I mean, we obviously we'll talk about the sentiment and positioning data, which flows against that, makes it tough to be willing to short a pattern like this. But just purely in terms of the pattern, having this bar in this spot is going to be demoralizing. If we had a lot of long interest, if we had a lot of speculative money in the market, I would be really, gearing up to do a lot of shorting. But we don't. We have the opposite. So we're kind of stuck in this. The way I said it yesterday is like it's like being in a washing machine. Round and round we go.
Yeah. So let's break into some of these pieces of data that we have in front of us, and we do have a lot. So we're going to kind of move a little quick. Start with the sentiment data here. The AAII, Brett, remains in pretty bearish territory. I don't think that that's all that surprising to people. I was just looking at the list. So back to back 48% plus numbers. Last time we hit that would have been mid-October, which of course was around the lows. The S&P hit multi-year lows during those 2 weeks. And then, you just kind of pull back. The last time we had bullish data this low back to back to was sometime in the spring of last year. So certainly sentiment has drifted down or has remained dour to say the least. So you got any thoughts with the price action that we've seen when you combine it with the sentiment that we've been getting for the last couple of weeks? Because this isn't just a one-time pop in bearish sentiment, and this is something that's really stayed up at pretty high levels for some time here. I think the 4-week moving average is running around that 45 level. So what's your thoughts here, Brett, on price action and the sentiment that we've been getting?
Well, yeah, I think the most important number is the bull side. Just seeing when you get down. Look at those last 4 weeks. Like we talk about festering around 20. We've been festering around 20. Really, we had a little bit of kind of people coming back to the idea. And you got to remember the question that's at the base of this is, a year from now, is the market going to be higher or lower at the same price? That is, they're asking a group of people who are active market participants that question. So this is the data you get back. It is 12 months from now, is the market going to be higher or lower or at the same basic area? And that's how you get your bullish, neutral, and bearish answers. So when you only have a stretch of, let's say 8 out of 10 weeks or so, where only 1 out of every 5 people is willing to say the market's going to be higher, you can read through to, what people's portfolios look like, right? You're not going to hold a lot of speculative exposure at that point. So we know that there's a lot of sideline money. And that's one of the problems with this market is for traders having like a bit of a struggle right now, I can tell you there's nothing harder than a market where everybody's bearish and everybody's right. Like that's the hardest market to trade because it's always crowded and it's going to move down in the most painful possible way, just a squeeze in your face every second because so many people are over levered on those bets, related to that basic sentiment. And it's just like walking across a minefield. If you want to stay on the short side, you got to be really selective about your entries. And it's tough if the world is moving in that direction. But at the same time, it sets up this classic contrarian long situation anytime there's a window of hope. So we've been kind of living in that world now for, I would say most of the last 6 months, but particularly now over the last couple of weeks with the emergence of this sort of mini banking crisis.
Yeah, and we did just slip below that 39.67 level that we're talking about. So definitely some pressure starting to mount on the bulls here, given this nasty reversal. So yeah, Brett, you're just talking, looking at the 8-week moving average here, sitting down. It's just been stuck in that 25 to 26 level for bulls for the longest time frame. That bull bear spread was minus 29, minus 27. You got to go again all the way back to the middle of October, the last time we saw it that low. So no big changes there. And as you said, it's would be a lot easier to short if everybody was all bowled up and we were seeing this price action. But that it's the idea of where is
it's the opposite. Yeah, really
exactly.
Tricky. It's really tricky.
So let's talk about some of these market characteristics, and we're going to kind of go through this slide here and just point out some of the obvious. Brett, if you got anything to add on as I just check off these, because we're going to circle back around and do a little bit a deeper dive. But we talked about markets proven resilient despite the headlines, and really what we're looking at there is that hold up at 38.80 last week, and just the working off of that level there, pushing up higher in front of Powell and everything. So despite all the headlines that we're getting, so that was one thing that we're watching. That kind of plays into, Brett, what you're talking about when everybody's bearish and you getting bearish news and the market's not going down.
Yeah.
It makes you wonder, okay, so is there anybody left to sell here? And that's probably
Right.
one of the fears going around right now if you're trying to short, not having that. So that's one item.
Just look at the headline flow we've had this year and just think about the fact that the market is well up on the year. And
Yeah.
here we are, headed toward the end of the first quarter.
Exactly. Just amazing given the headlines that and the whole wall of worry that we got. But
Right.
quality's been outperforming junk, about up 3% on a relative basis. No surprise there. People getting out a little bit less riskier assets and balance sheets, of course, as we've seen in the bank. Growth's been outperforming value. Defensives have been outperforming cyclicals here. That's probably a little bit of economic concern there. But then it kind of gets a little odd where high momentum has outperformed low momentum, which we could probably argue about the peak cycle argument there, maybe driving people into
You're talking
some
about
of
earnings momentum there, correct? Or are you?
yes.
Yeah. Okay.
But but what I'm talking about is some of the names that we've seen with like growth outperforming value and everything. That is basically what I see. Number one, I think people think tech's a little bit more defensive in nature against a recession, because I guess they don't have as many variables going in there, and it's easier for them to lever margins, as we've been seeing over the last couple of earnings reports. But also, I think, and we'll talk about this a little bit later, but the Pavlovian response to anytime we think that there's some peak rates going on. And I was looking at the monthly and the S&P continuous, Brett. And you could basically point the months where people had the idea that we had hit peak rates and
Right.
stuff. It sticks out that much.
You want that duration ad.
Yeah, exactly. And then large caps have been outperforming small caps. Of course, small caps, lots of banks and energy in there, which has just been two uh, poorly performing asset classes. And the large caps, given that they have the best balance sheets, has certainly been a destination for flow.
And the
Retail.
dollar's been getting shelled too.
And the dollar getting shelled too. Very good point, especially for the multinationals there. Retail participants, about 8.9% of the total market volume. That's in the 63rd percentile. So they are involved here more than they usually are. Non-profitable tech has been resilient, which kind of flows into what Brett and I were just talking about there. Strong balance sheet stocks have outperformed. Again, I think that's the move going into the large caps. And here's going to be an interesting discussion for us, Brett. Bonds and stock market divergence with messaging of growth. And we'll talk a little bit about whether or not the Fed and FDIC backstops was indeed QE a little bit later on in the show. Retail money market funds seen huge inflows, migration away from deposits into what's being viewed as a little bit safer asset classes. It's one of the reasons why I liked Schwab and wasn't expecting them to get as beat up as they did, but here we are. Then we got money market flows. That was 121 billion of inflows, if you're curious. A record issuance of 161 billion in federal home loan banks, and that's all part of some of the backstops that we've seen going on. That banks are accessing the Fed discount window there in order to shore up the balance sheets. The repo market volume was up 170 billion week over week. Now I think 109 billion of that's going to ended up being Silicon Valley, or Signature Bank, I should say, borrowing at the Fed's discount window up 153 billion. Again, money market flows for Refinitiv saw net 96 billion, which is the largest inflow in the first 2.5 months of a calendar year since 2008. You never really wanted to see comparisons to 2008. And then finally, U.S. Treasury bonds see the largest monthly inflows on record in February. So this is the dynamics that we're dealing with in the market. So Brett, reading off that checklist there, what's jumping out to you out of that?
Well, first of all, I just want to clarify. So the bond and stock divergence, I'm not
So
seeing.
you see stocks rallying and growth stocks pushing it, yet you're seeing the
Bonds
bond markets,
rally too.
the bonds are rallying. I should have probably put in yields there.
Rates. Okay, rates and stocks.
With rates showing signs of a what you may call it, of a recession coming, while stocks have been holding up and
But
rallying.
okay, yeah, but I mean, I think that we've been living in a world for at least a year now when rates go up, stocks go down.
Okay.
Right?
Right.
I mean, think about
Yeah.
it. You know, when we broke above 4%, everything tanked. Like, I think that this is, I think, a continuation of that same dynamic to some extent, right?
So do you think that the rate stock cycle has just kind of been broken at this juncture?
I think that I think bonds and stocks go through like phases in any market cycle. And there's periods when bonds, not rates, but I'll talk in terms of bond prices and stock prices. There's times when they are in sync, and there's times when they're sort of randomly correlated, and there's times when they're inverse. And it depends on which extreme you're at. But I think that, there's different it's like the life cycle of a bull cycle and a bear cycle. A whole market cycle has these different, the life cycle has these different stages in terms of the correlation between bonds and stocks. And I think it pretty regularly through history, we see it kind of evolves from one of those types of relationships to another at a certain point. When rates are rising and high, stocks are going to hate that. But rising and low typically means good things, so it really just kind of, it depends on where you're at in the cycle. And right now, with an inflationary environment, I think people want to see lower rates, and they take that as a good sign. It takes pressure off in terms of people being, it's the price of money, and people being able to deal with adverse conditions. If the price of money is lower, they're more likely to be able to successfully deal with adverse conditions. So I think it's some of what we're seeing. And then, of course, the growth stock divergence and just being able to have more duration.
Right, right. So, again, these are some of the things that we've been seeing over the last couple of weeks. Definitely a lot of concern around the is evident by the actions into the money market funds. So, for
Yeah.
me, Brett, it's got a lot of similarities to what we saw in January, where we were getting that rally. I'm not saying it was another short cover rally, but it feels like the response for the markets is anytime they see the rates dive down, like you were saying, they go towards those growth names. But there could be a little bit of this time it's different, in which they're running into an area where there's really not going to be that support level. It could be a trapdoor given all the money that's flown out into the money market funds and into a little bit more safe havens.
Well, it's like if it really gets real on the
Yeah,
recession side, like it's
right.
sort of like, hey, first there's a financial beneficial side effect, but then, if the bottom's coming out of the economy, then, bonds are going to continue to roar higher and rates are going to go down, and suddenly stocks are going to start tanking. And you enter that next phase of that complex relationship, like we saw, in like the fall of 2008, when, bonds broke out in this massive breakout and we had, 1,000-point down days on the Dow. I mean, it's not real for people right now.
Yeah. Just keeping an eye out here on the markets. We're at 39.60 in the S&P futures. The S&P is now down on the day. Just keeping a close eye on the NASDAQ as well. We got the NASDAQ still up 0.5%. That's trying to find some support at 12,750. So we'll continue to monitor this. But Brett, the McClellan Summation Index here. This is a chart that I know you like to go off of. Any thoughts on it? As you noted, it hit the red dot.
The red
Which is
dot.
what you were looking for. So you want to just explain to people this chart again and what that red dot means?
Look, it's the same chart as last time. People who watched the last one will remember this chart. I just wanted to kind of, refresh your attention on this because, I mean, hey, past data is no indication of future performance. But it's 50 years, every single bear market is followed by a red dot, and that's been a correct bullish signal every single time. This is a breadth indicator. It's about kind of like a super breadth thrust. It's about a negative 1,000 reading going to a positive 1,000 reading. In other words, everybody sells everything, and then at some point it cycles back to everybody starts buying everything. And when those two come in combination close enough together, you get a red dot. And every single bear market in the past 50 years has been followed by a red dot, and there's no red dot during a bear market. So we just got a red dot. I could have put a pink stripe there right before it because we have a bear market. I just didn't because it's not complete yet in theory. So, but we are living in the way that I put it to Gavin earlier in our chat, we are living in a post-red dot world. And maybe this time it's not going to matter, but still, it's a fact to take note of.
All right. And again, just keeping an eye out on this action. One thing to throw out there, Brett, that could be of interest, and before anybody's getting all bared up there and ready to just lean on this, Janet Yellen's coming on at 3:00, so we do want to remind people of that. She's her presentation in front of the House. If she steps back that comment, that could set off a bit of a squeeze. So just be careful if you are trying to short this with both feet.
It's so possible.
Yeah.
I mean, she's gonna get like we could be in a game theory landscape, whereas she's saying something to give everybody confidence, and then she's saying something to say, hey, but this doesn't mean go into a speculative frenzy, and then saying something to give people confidence, and back and forth we go, kind of like an old sort of Greenspan Fed speak lesson of trying to make sure that you don't take anything she says too seriously, so she doesn't set anything off. But still, we don't want all the people, running to their local ATM and taking out everything right now. Right. So she's kind of walking that dance, and I would not be surprised today to see it moderated back in the other direction a little bit. Yeah. And I mean, if there's a mechanism where there can be a judgment call about backstopping all deposits, and you kind of get the idea that she's not willing to say we're guaranteeing all deposits on every bank because that's a rule in the game theory landscape. However, she is willing to say, oh, in this case, we're going to backstop everything. And that it's likely that if there is a next case to this banking crisis, that's what she's going to say. And if people get an idea of that, we're right back in a world where there's a blanket deposit, backstop.
Yeah, although at some point they're going to have to stop playing the games because this does risk the chance of spiraling out of control if they continue to play games. So, but keep that in mind as we start heading into the final hour of trade. So there's the McClellan Summation Index.
It says 3 Eastern.
Correct. She'll
5
be in
minutes
front
from
of the
now.
House. 5 minutes from now.
All right, people.
So we'll be monitoring it for headlines there.
Ears and eyes open.
All right. So Brett, and we've talked a bunch about this, so we'll kind of move through some of these slides. But bearish investors, this was from the Bank of America Fund Manager Survey. Most bearish since the start of 2023. That's not really all that long ago, of course, but just kind of matches up with what we're seeing there in the AAII sentiment. So it is across a couple of surveys, and also in the JP Morgan one, which we'll show you some of those stats here in a little bit. Here is the spike in retail market funds. Apologies, this is the best I can get for the graph, but you could just see that huge spike up. I mean, you got to go back to around the pandemic, since we saw that much fear jump into 2022, saw some similar action, and you could see these things have tended to unwind nearly as fast as they jumped up, but big pop there.
Well, it's a week over week, right? It's not really coming back out.
Yeah,
right?
Yeah,
I mean,
so
it's just a flood of money in.
No, this is the flows. This is a rolling 2-day window flow here. So that spike there is March 13th and 14th that they're
I'm just saying, if the next spike is a small spike, it doesn't mean that all that money came back out.
Correct.
Yeah,
But
it's not unwinding. It's just
if it
continuing.
unwinds under the zero is what I'm talking about.
Yeah. If you need a big down spike to counter this thing.
Right. So, that's something that we'll be watching closely. Like you could see the whippy price action at the beginning of 2022, which would have probably been right around the Ukraine, Russia war. So,
Now the
but
question is this getting the money out of your deposit accounts, or is this
yes,
getting money out of stocks?
this is deposit money flow. Well, that is a good question because it doesn't really
That's the
give you that
question.
breakdown. A lot of it is certainly deposits going in, and we'll show you some of that data
Yeah, it's
here in a little
probably
bit.
uninsured deposits
Yes.
heading to. I mean, you could still.
Yeah. And so
I
I
don't
mean,
know how
there's
much safer it is.
yeah, right. I mean,
mean,
look at what
I don't
Schwab's
know
doing today,
if
right?
this is, but it's certainly risk aversion. I
It's
mean,
risk aversion,
I
and
think probably a good part of it is just coming out of it. Look what they said they're going to wipe out. I mean, they're going to wipe out. Your financial stakeholders in financial institutions that have a
bunch of
problem.
Credit Suisse, and that's another.
Yeah, I
thing
mean,
that
I
I'll
think
get into.
you can look at those regional banking index, and I would imagine that a lot of that is money coming out of financial stakes in financial institutions rather than deposit accounts, but maybe not.
It very well could be. So we were talking just about breadth. So this is breadth as evidenced by the ratio between equal weighted and cap weighted S&P. So this is the SPY versus the RSP, Brett. And you can see that's all a decline in energy and bank names there, which is the biggest difference between the equal weighted and cap weighted.
Yeah.
So that just kind of highlights where that price action's been and the weakness that we've seen. This is
You're not going to take the money out of the beneficiaries of the AI revolution right now.
Right. So we got that breadth deteriorated. Here's Goldman Sachs breadth index, which you can see it's currently at 4. Anything under 5 is considered now a breadth by them. But you could see the wide range going in at the beginning or in the middle of 2022 that led to that run. And now we're just kind of seeing a little bit of that dying off, and probably a lot of that has to do with all that money that's flowing out. I mean, if you think about the thousands of banks that are traded on the exchanges and energy companies too.
Hey, do we have any Yellen headlines?
No, but I did just
Market
get
is
his
launching right now. God, I was thinking about just buying in front of her.
Yeah, let's see. Yellen, important.
Look at this.
Anti-contagion tools could be used again. And there we go. So that was that squeeze we were just talking about. So hopefully we got shorts out of
She's
their
taking back the
position
take
there.
back.
Taking back the take back. So
we're doing that dance. We're gonna walk over the line. We're gonna walk back the other way. We're gonna walk over the line.
Little bounce in the arrow. We'll see.
Right. We're just managing expectations. She's saying I'm not gonna make a rules-based determination that applies to everything in the universe ahead of time. I'm gonna leave myself the freedom to say that we're making a subjective decision in each instance, but nudge, nudge, wink, wink. It's a blanket.
Yeah. That's basically saying I screwed up yesterday. Let me walk this back and assure you that the banking sector is in good situation. So here we go. This is the type of market we're in, Brett. And big bounce back.
And everybody's
back
short.
to 39.85, and everybody's short. And I mean, so luckily we got that on everybody's radar here. So hopefully none of the shorts were sideswiped by that, and there we go. But get back to the conversation. We'll keep an eye out on Yellen comments too. Brett, just as a quick heads up, the two that I'm seeing out of anything is Yellen says important anti-contagion tools could be used again. Yellen says strong action taken to ensure deposits are safe. Yellen speaks that was in her prepared remarks. So prepared for additional deposit actions if warranted. So clarity coming in there from the Treasury Secretary. Now, I'd love to see this pop up to 4,020 maybe, and then I would lean on it personally.
You know what she's saying though. Saying the next bank that fails, we're going to guarantee all the deposits, no matter what bank it is.
basically, right?
That's
So
what she's saying.
yeah,
That is a blanket deposit guarantee. Just she's not saying there's a blanket deposit guarantee.
she's hinting that there's a blanket deposit guarantee.
Exactly. Because it crosses a line to say this is our new policy.
Yeah.
But
So
still, is what we're going to do.
Yep. So, so again, just kind of keeping an eye out here. So,
KRE, look at that move in KRE.
yeah, let's look at the KRE. Is a scalp out there with anything? He might be trading this.
3 or 4% in about 2 or 3 minutes.
Yeah, there's so scalps up there with the commentary that we got. So okay, so again, we'll continue to monitor this going on as we have our discussion here, Brett. So we talked about the breadth, Yellen advanced decline line. This is cumulative advanced decline line, so that continues to push higher here. Looking, it is showing some signs of flattening out a little bit. So this is market technicals and financial conditions. This is a chart run by Morgan Stanley here. So you could see that it's just kind of continued to climb up higher going throughout, but it has started to broaden out. The last times it broadened out would have been 2015 through 17 and 2011 through 2014, which
but the first one of those that you just mentioned, the 2015, let's remember what was happening then. That was the complete implosion of the commodity space.
Right.
The complete implosion.
The yuan devaluation as well there, right?
Right. But I mean, that was oil went from 100 to 26. We had everything across the board, all the commodity producers. This is what back when we were talking about, you remember the conversations about the bank loan spring and fall periods where they revalued everything, and there's a possibility that there was money being cut off.
Redemptions.
Yeah, right. Where the redetermination and
redetermination.
It was just like it was a whole side of the economy that was having its own 2008 moment. It's just the market bifurcated, and at the end of the day, the S&P was down, 10% in early 2016, and that was it.
And then 2011 to 13, we had the European debt crisis, the tapering tantrum, all that going on there. So, but the point being is at times of consternation, you see this flatlining a little bit, and that's exactly what we got going on.
Well, especially if it's just part of the market that's suffering terribly. Right now, it's the banks. Back in 2015, it was, oil and heavy materials. And so it's like when there's a problem in an area of the market, but not the whole market, of course, you're going to see, breadth really suffer.
All right. Tail risks from the Bank of America Fund Managers Survey. Systemic credit event popping to the top of the charts there at 31%.
Naturally.
Taking over inflation, which, of course, we've discussed how you could kind of combine the top three central banks, stay hawkish, all combined because they really set off each other. Geopolitics worsen. That declined a little bit, but still staying in the ballpark there at 14%. Deep global recession, that declined a little bit, but probably because everybody wanted to say systemic credit event. And then stock market crash actually came on at number 6 here, Brett. It was only 1%.
What a strange one.
Right?
Just to say it. I mean, it's pretty much implied in any one of these bullet points that you're.
Yeah, that could set off.
It's weird to look at stock market crash as the catalyst for something rather than the result.
Yeah. So I mean, but obviously we've seen systemic credit event come up to the top of the list, and then when we pop off to the next,
but we're just to take it back for a second.
Sure.
Just I've never seen that. I've been following this survey for years.
Yeah.
I have never seen stock market crash as an item.
Right.
I mean, just as a sentiment indicator broadly, we now live in a world where stock market crash is on this list, which to me, again, it just strikes a contrarian chord in me. Like, this is, if people are, I mean, there's not much. If I saw bigger bars there, if it was in the number 4 spot or the number 3 spot, I'd really just have to buy everything.
This is like Sam Bankman-Fried on the cover of Fortune or whoever else.
Was stock market? Yeah, like what if you got you're the next edition of the Time magazine had stock market crashes coming on it.
Yeah.
Obviously that becomes impossible. Like people are most prepared for that outcome. I mean, here it's just a couple people.
Yeah.
But still, I've just never seen it on this list. It rings a chord with me.
Yeah, no, it's definitely interesting to see it. So we do have markets rolling back over here, back to that 39.67 level. We'll see if the bulls could step in and defend. Now, taking a look, Brett, risk perception here. Obviously, we talked about systemic risk and everything. All of these were up higher: emerging market risk, business cycle risk, counterparty, geopolitical, credit. Now, you could probably make the argument that they all build off of each other, but it just kind of goes to show how broad concerns are about risk out there. And, this chart really kind of highlights it. That's, again, from the Bank Manager's Survey. So you got any thoughts on this chart?
I mean, there's more risks.
Yeah.
Obviously.
Obviously.
So there
right?
were, yeah. I mean, you pick any time in history in this, just the idea of there being multiple serious systemic wide kind of risks in play. Obviously, right now, first time in a long time, we've had the Fed engaged in a strong hiking cycle, inflation bad, a war going on, et cetera, et cetera, et cetera. There's just more risks.
Yeah.
So we've seen this. Yeah. I mean,
and that's pretty evident here, right? So, and we'll talk about that impact on credit here in a little bit. So source of the credit risk,
this is
U.S.
interesting.
shadow banking pops up to number one. You remember this was China real estate for the longest time. Second, corporate debt flying up there, and we were talking about some of the squeezes that we've been seeing in yields, Brett, right? In the HYG and the J&K, really highlighting that corporate divergence there. I've seen a lot of comments about the liquidity in corporate debt being very poor right now. So, and we're going to discuss the knock-on effects on the markets there. Then we've got DM real estate here, right? So that is the developed countries' real estate, which there's obviously a lot of concern. Certainly the office space, we've seen that. China real estate, that's cooled down a ton, probably just because everybody else is just jumping to the forefront there. European sovereign debt, that's down from the prior numbers. Global pension funds, it's actually down from the prior on that. And then emerging market sovereign debt. So what we've really seen here, Brett, in this source of credit risk is a flip from worries about the emerging markets into the United States in particular, and and developed markets in general. So, any thoughts on that?
Yeah. So I mean, so again, this is about risk. It's not what will go wrong; it's what could go wrong. What's getting on your radar? So there's 2 points to make. One is, obviously, the only way that you can look at a T-bill devaluation process as being a systemic banking crisis, which is what the narrative that's currently in play, is if there is some gigantic other factor hiding in the wings, right? There's no way the T-bill devaluation on its own does it. It's why Silicon Valley Bank was the one to blow up first, and then we had a crypto bank blow up second, rather than, run-of-the-mill average corner bank, because there's some other factor that is really the problem. And then when you add in the big hole in the balance sheet because of what if you have to mark to market your T-bill losses, then because this other factor is already there, that's already a problem, the two together and your bank, right? So that's the only way that you could look at this as a systemic banking crisis situation with the most visible possible asset, with the most predictable situation ever in terms of what your losses are going to be, is if there's some hidden other major monster. And so, of course, if there is a shadow banking a vulnerability that's at a big scale, then when you add in this mark to market hole, then everything's going to blow up. Right. So clearly that's the biggest thing to be scared of, is if everybody has another, stealth giant boogeyman hanging out in there, and that's turned bad. And when you get this, more mundane negative catalyst, it sets off the whole thing. So then you do have 2008 if it's that bad. So that's the thing to be most scared of. Corporate debt then becomes the widening of the credit spreads, people exposed to it. You're heading for a hard landing. Corporate debt's going to get crushed. But I think the most interesting thing about this is the people who are responding to this survey that are giving these answers are major money managers tied in with big institutions. So the question you have to ask yourself,
what are they seeing?
Is this intel about shadow banking exposure or not? Is the question. Maybe it's just speculation, but what are they seeing inside their firm?
Yeah. So, yeah, I mean, it's a good question, and one that obviously the market's asking here. Just keeping an eye on it. We're bouncing around between 39.67 and 39.80 at the moment. Financial conditions, they're tightening, Brett. No surprise there, obviously. And we'll go through a little bit of that in deeper detail here. Certainly, the risk appetite's a little bit lower. We've got higher rates, of course, so that's all factoring in here. And the FCI, that's from Goldman. Credit and counterparty risk. This is from the Bank of America Fund Manager Survey. Now at the highest since May 20th. And that just kind of circles back to what you were just talking about.
Just then, right? Same
Yeah.
thing. Is this intel?
Yeah. Yeah. And, the counterparty risk certainly suggests that, I was going back. Unfortunately, they don't do LIBOR anymore because I was looking at the 10 spreads and the LIBOR OIS and everything.
I mean, the 10 spread's not that crazy, though. It hasn't been. Yeah.
No, 10 spread hasn't been, but it's based off of LIBOR, right? So
yeah, it is, but it's not. It's outside versus inside. It's a rate versus the external rate, which tells you about if you're not guaranteed in those transactions. So how much do you doubt? In other words, how much do you doubt counterparty's ability to make good? Or the way that I always look at the 10 spread or any measure like that is kind of like the banking system works if it is a network tied together by strings that are unbreakable.
Well, it's a fractional system built on trust.
Sure, but like
trust is decimated.
Right. The customers trust in the banks trust in each other. But if you end up cutting those strings so that the nodes are just separate, then it falls apart. And the second you get something like a big spike in the 10 spread, you know that they're doubting each other as even overnight swaps counterparties. And at that point, that's 2008. That's where you get to. There's no way around it because a net, like think about how a rope hammock is made. If you cut all the strings in between the knots, you just got a bunch of little knots laying on the ground and nobody can sit in the hammock. The hammock is what holds up the economy. And if banks start to cut each other off because they're worried about what's hiding under the surface and they can't make these really quick, simple, large scale transactions, even for something like overnight swaps, then if they're scared of each other on that level, then you've got that hammock is just all the strings are cut. It's just a bunch of knots laying on the ground and everything falls apart. So what we're seeing is, and I mentioned this in my notes the other day, when you see the discount window borrowing go to an all-time high, but you don't see the 10 spread taking off, to me, that's a really important kind of bullish signal. They're ensuring their foundational capital position rather than everything's falling apart and they don't trust each other.
That's the last
so it's kind of the ratio between the two. You see the discount window borrowing, but you don't see the 10 spread. Then it's kind of an important signal, I think.
Yeah, so we'll be following that as we go along here. But so we're just talking about the high yield corporate spreads. Brett, here's a perfect example of that. This is popping up as we could see, getting up to the highest level since late 2022 there. So they have been marching higher after dipping down in early February. So corporate spreads over U.S. Treasury starting.
So you did have corporate spread. You just put it in?
No, I thought I told you that I had.
Okay, I thought that you didn't have one. Yes, my bad for not seeing it. But good.
Yeah, all good.
Well done.
So yeah, so there we go. So basically, what we're just talking about with the HYG and
This is
the
recession risk right here.
yes,
Yeah.
yeah, and it shows why that corporate debt jumped up so high on the list because of these spreads here. Also, just goes to show, how much you gotta pay somebody to take your paper these days,
Which
right?
in absolute terms, it's not so bad. It's just the rate
Yeah,
of
but when you
change.
think of how elevated the T-bills are at this point, right? And this is a spread above that. So I mean,
No, I know. I'm just saying, like
yeah,
it's like there's a base rate, and then there's what risk you're going to take for a default risk, and the absolute number is important because that's your default risk assignment. You're saying here's what default risk is for this stuff, and it's in absolute terms not bad. It's just the rate of change is, and it could just be another, and probably is just another sentiment indicator about people getting cautious, which, there's a contrarian bullish side to that. But if this plods along higher, it's a pretty good indication of
fear.
much bigger headlines to come.
Yeah. All right. Equity risk premium. This is starting to get in a little bit more on the recession side of things. Basically, all this is showing is that people aren't seeing the value in the risk of holding equities, and we are slipping lower here, Brett. So watch that back down to 39.67. But the equity risk premium, look at that dive down there. Part of that, this is the Tina argument, right? Or that the fact that Tina no longer exists, and that's being reflected in this equity risk premium. Any thoughts on that?
Yeah. So, I mean, obviously it fits kind of in the context of everything we've been seeing, but yeah, I mean, there's this headwind that's there in a hiking cycle that's undeniable, and it's kind of that point where, we said 1,000 times on different strategy meetings that these things tend to progress until something gets broken.
Yeah. So, and that is pretty much what we're seeing starting to get play into here. So, this is another area we'll be watching. This is from Bloomberg and Morgan Stanley. I was a little bit surprised at this. Europe is king, Brett.
Yeah.
Long European equities, the number one most crowded
Well, but
trade
from, pauper
from the
to
view. Yeah.
king. Yeah.
Right.
I mean, there's a sort of, snapback
Yeah.
quality to this with the Ukraine war.
Long U.S. dollar, number two. Obviously, a little bit of safe haven
By the
going
way,
on there.
let's say the weather is probably a big part of this.
Yeah, just the fact that nat gas prices didn't spike up, so now
So,
people
I mean,
aren't
warm,
as worried.
here we are in Chicago, and it's not even close. I've been here for, I mean, since we came back with the triplets from California, it's not even close. This is the mildest winter that we've been through, right?
Yeah.
I mean, it's not even close in the last decade or so. It's been crazy mild. We had about a weekend of Chicago winter weather.
Right.
And, to come from a situation where in August, that people in Germany are sitting there thinking, Putin, we can't pull out of this situation. And Putin, if things get to, a brutally cold winter, imagine the leverage you have if you're the supplier for all of Western Europe for energy to heat things. Like, the leverage there is so powerful. And there's such the possibility of completely just shutting down what is the largest economy in the world. I mean, we say China and the US, but it's the single currency for euro that's the largest economy in the world. And if that gets shut down, and that there was a weather related component there as to whether or not that was possible, I think pretty clearly, and to have it be one of the mildest winters probably in history is quite a remarkable turn of events.
Yeah. Yeah. Definitely been driving people back in and easing some of the fears around Europe.
Yeah, you're so hedged up for that brutal winter, and then this is what you get. And I think that probably is a scramble.
Interesting to see the long ESG assets too, is when you hear all the talk about people pulling the ESG assets out, but here they are at number 4. And then we got US Treasuries coming in at 5 here, and it's down.
Do you think
a little
ESG
bit.
is like long duration?
I guess it could be to a certain extent.
A lot of unprofitable, like, revolutionary solar wind kind of projects or.
Yeah, I mean, it definitely could factor in on that. So I'm not sure how they're breaking down ESG assets. If it's just funds, a lot of money market funds out there, they could be seeing some money flowing into it. So
Or
just
maybe
keeping,
the warm winter, right?
yeah,
Confirmation of global warming. So we need to
just keeping an eye on the
get on
site
it.
too. We got Momentum Trader buying the 393 SPY puts here. Scalp Trader getting into DPST, looking for a bounce squeeze in the regional banks here. That's the 3-time leveraged. And Momox buying the FAZ here, buying calls in the FAZ, which is the bearish financials. So a little bit of a divergence going on between the two traders there. So we'll watch that play out. International flows. This is in the U.S. equities. Obviously, a big dip down, which probably helps explain that move into Europe. But we talked about emerging market debt improving here. So really just seems like a lot of foreign money coming out from the U.S. here.
Yeah.
So,
well, I mean, do you ever think about this in terms of like what an asset Silicon Valley has been?
Yeah. I mean, with all the money that's flown into it, for sure.
Like there was a protected geographic nature to innovation until now.
Yeah, and that's definitely been busted up here. And I mean, certainly, you could also just take a look on the international side too, with what went on with Credit Suisse and things like that, where you're just seeing bondholders like the Saudi government really thrown to the sidelines there with their investment in Credit Suisse. And when you see stuff like that, if you're an Eastern government, you kind of wonder if the greater good move by Western governments is all of a sudden going to kind of hurt your investments. You see what the U.S. is doing with TikTok here, and you wonder how much of an impact that's having on foreign business too, Brett. I think
so
that's
like a
gotta get
realpolitik position.
Yeah, exactly.
Where consequences.
Where if
it's like the energy thing, your energy prices are going to be higher.
Yeah, exactly.
You're not buying the Russian oil, so.
Right. But whatever the case might be, or, emerging markets just looking a lot more attractive. There's a lot of foreign money flowing out here. This is again from Goldman. You could see a little pop up in domestic, but big outflows from foreign investors in the U.S.
When that coincides with the dollar getting bad.
And this is a 4-week moving average too. So, just watching those flows. Okay. Recession fears, Brett. So here's a few things that we want to bring up. And one of the things that kind of keeps me a little cautious on the markets. Last week's development, typical late cycle environment between large central bank tightening and the likely recession that follows. We're going to show you a chart on that in a little bit. Risk assets have done little to price in the probability of recession. We got a chart for you coming up on that. Base metals and European credit are the only things pricing in a recession. So again, Europe's a little bit more attractive on that front, meaning that it's a bit cheaper. Hopes that the central bank will come to the rescue, but will they fight another war, or are they just going to continue to focus on inflation? That's going to come into play where the Pavlov, we see it going on right now over the last 24 hours where everyone's like, oh, the central bank's going to have to cut rates. Let's buy. And then you wonder if they don't, how that's going to react here. Only way for central banks could bring down inflation down was through recession. So, the whole idea, let's raise till we break something. And you saw Powell mention how that was doing some of the work for them. The tightening of credit was doing some of the work for them. I've seen anywhere from 100 to 150 basis points of tightening has been taken off the table because of the price action the last week and a half. Will the old playbook of buy the dip come back? We just kind of discussed that. We'll dive deeper into these as we go through some of these slides. New playbook is assessing how much economic damage is being generated by the central bank rate hikes. So, a lot of fear going on there that they're just doing enough that's going to damage the economy. The debate around rate hikes, will that change when people start losing their jobs? It's going to be one thing, but of course, we'll already be heading into a recession at that. Soft data points point towards a recession, but is not shown up in the hard data. And then unforeseen catalysts that, in the hindsight, forces participants to acknowledge what has been right in front of them all the time, and that is earnings expectations versus the Fed rate cycle, and that it's kind of like what you were talking about, Brett, yesterday with Powell, when he was like, oh, I'm not really sure what happened to the banks. And what was happening. They were raising rates for something like this to happen. Will something like that come out in a recession where we've been talking about it all the time, and then all of a sudden we're actually in a recession? So, Brett,
which is typically the case.
Which is typically the case. Of all that we just went through, is anything jumping out in your mind there?
Yeah, I mean, like this is the most. It continues to kind of impress upon me, like so for people who have been doing this for a long time, like Gavin, like me, we're old. We've been doing this for a long time. You get into these. This is maybe you don't feel this way, but I feel like. And this dovetails well with the sort of contrarian instinct that I have in terms of the sentiment data. And maybe this is a misleading path for me, but we take our paths. It just feels like there's such visibility. Like it's like looking at this banking crisis and saying, like, how do you say you don't know what happened when it's,
Painfully
mark to market T-bills? Like, it's the most foreseeable thing possible, and especially when you're the regulator and you have backdoor access to every bank at a phone call and everything that's happening, and to be like, wow, we're going to have to really look at this because, boy, sure came to as a shock to us that, that a bank, the 16th biggest bank in the world, was vulnerable based on the fact that we've been raising rates like crazy and obviously, knocking down the value of the T-bills they held. And to be in a position where you end up saying, and I think obviously apocryphally, that you don't know why it happened is a terrible decision from a leadership standpoint. But it's just crazy to be in that position at this point in the cycle. But there's so many things here that are that there's echoes of that basic sense. There's so many things that are such visible boogeymen, such anticipatable problems. So like there isn't a sense to me of like if you go back to 2008, sure we could see some of the problems, but and in retrospect, of course, you're like, well, of course I knew in September 2007 that it was all going to fall apart. But when you're going through with the hard right edge of reality, it really wasn't like that. And you're like, this is contained to real estate, and you didn't know what was lurking under the surface, and that all these banks, if you read like something like Michael Lewis's The Big Short, like these guys, the leverage they had in play and weren't telling you about, and the fact that it was one of those types of recessions that isn't about the the inventory to sales ratio. It was about the people who produce credit, and that they were all sitting there with a knife in their heart and pretending they were okay. And the whole thing collapsed. And this situation seems just so fundamentally different to me from that. But maybe it's not. Maybe there is this shadow banking problem that's much bigger scale than we realize right now.
Well, I've been saying for the last decade, Brett, that this is exactly where
that you've got a ticking time bomb that is hidden behind a different set of doors.
And adding to the problem is you had the I don't want to call it overregulation, because I mean the large institutions are proven to be sound, and so but it's not that there was no regulation going on elsewhere, but it was much lighter, and any money that couldn't get in through those big banks to go back through the back door through some of these other institutions. And we got some numbers to bear that out too. But just kind of with that recession talk, Brett, here's a chart of what's pricing in, and this is based off of what your typical decline would be during a recession. And this just highlights, base metals have been at the forefront here, but
let me just tie a bow first, real quick. We just
yeah.
tie a bow. Basically, it's been extraordinary to me to see this situation play out with so much apparent foresight and awareness about all of the risks that are in play, and the positioning to be so hedged and so carrying much larger cash balances than typical, and just kind of situationally seeing around the corner. And in my experience, and this could be completely off in this case, but in my experience, those are the moments where it's, it's like that old stat that economists predicted 7 out of the last 4 recessions. You know what I'm saying?
Yeah.
Like
Yeah.
this, just it's so visible, but it may very well be true. Maybe it's a train wreck you could just see coming from a mile away. But usually, in my experience, that's not how that process goes. Usually, it's that punch you don't see that knocks you out. And maybe there is a punch we don't see right now, to your credit, shadow banking, and maybe it takes on the system. But there's a lot of punches that people are very clearly seeing and very clearly hedging for.
Yeah. Yeah. And, so again, it's going to be something that's on everybody's radar. But like Brett said, it's that one that you're not expecting. I thought even you could look at Credit Suisse, talk about it being a SIFI bank, but everybody knew that was a train wreck for the last 8 years now.
Sure.
So we haven't really gotten that surprise sucker punch yet. That's for sure. Silicon Valley Bank and the others you could argue, but it's that institution that goes down. I mean, everything's basically been San Francisco and New York based, really, for the most part. It's that institution that goes down that you're like, how'd that go down? That would be the real knockout punch, I would think.
It's got to be another 2 of them. Yeah.
Yeah. But just looking, you can see not a lot of people are pressing in a recession, even though everybody's talking about it, right? So this is some of the asset classes here that we can see. The earnings snapshot, they're looking for growth there. This isn't pricing in any. Usually there's a 13% decline. You can kind of see
I'll tell you
that.
what, right there is the most interesting chart in this presentation.
Yeah.
To me.
Just because the consensus estimates have not priced in any sort of a drawdown, you're saying?
Well, it's just at odds with the positioning data and the overall sentiment.
Right.
If this is real, big earnings growth
AAII
over the next couple of quarters, then why are all the other data points happening?
Yeah. Well, for me, I think that this is behind the
You're saying this is the wrong
consensus estimates. I think the consensus estimates will be the wrong one.
So they probably right. There's an industry there, right? I mean, we've seen this before. 2001, 2002, weren't there lawsuits over basically the same thing?
Yes.
Just like
Yeah, I mean,
they've got relationships with companies. They're not willing to downgrade them publicly.
And in fairness, we haven't seen it in the data play out yet, and that's one of the things, right?
Well, so they can get away with it because they know they're going to be blackballed.
Data versus the soft data, right?
But isn't it like the analysts are going to be blackballed on Wall Street if they come out and massively lower their earnings estimate for a company that the bank also has relationships with?
Yeah,
right.
There's definitely that aspect.
I mean, that was what we saw in 2001, 2002. So you come out and you're going to downgrade whatever it is, Best Buy, whatever, but if you do that, then you're simply not going to have as much access to the company as an analyst on Wall Street.
Yeah, and
you think that's a factor?
It factors into a certain degree. I think it always does, right? I mean, you could argue maybe some easier comps possibly at play here for some of the industries, but I think
unless
that
these are the rational ones.
It could be.
People are swept up in psychology for positioning and sentiment.
Well, I got a reason why I think that this is going to come down as we go along here, and it's so, but I wanted to highlight this next to the pricing and recession, as none of them are.
It's a very good.
And again, here's some of the sentiment. This is Philly business outlook. You can see that diving down here. Small business optimism already depressed before the recent events, but again, this just kind of builds off of that weak sentiment.
It's going to be regional bank credit availability.
Yeah, and again, this is just kind of sentiment, data not matching up with sentiment.
Which, by the way, just to go back to the last slide. Just to go back to the last slide real quick before it passes us by. That sort of reaction can reverse itself very quickly if there is a Herculean, incredible job of shoring up the banking crisis situation.
Correct. I would agree with that 100%. But we just kind of take a look at ISM manufacturing versus cyclical's defensive ratio here, where usually when this is going down, you see that drop off. So I do think that there's also that element, Brett, where people are just holding out hopes and they haven't really been hit in the face with any true recession data. Maybe it's because there's just still too much liquidity. I think that there's another issue that we'll get to here in a bit, but you can see this could just drop precipitously too, as you're talking about. You could get as quick of a turnaround here
But
on this.
did you see scalps come at 1529?
I did not. What do you have to say? Bloomberg highlights that Yellen's prepared testimony remarks were changed from the Senate version yesterday to specifically include the. Yep, that's not a surprise, right?
It's remarkable.
So
how
just
fouled up this process has been.
And on top of that, SL Green Realty down 7.5% on a Barclays downgrade. Just the office realty. That's who they're going to be saving next, right?
Yeah, maybe.
Maybe we'll see.
It's going to be a park. It's going to be a park. Get out of the building, put some trees up.
But so back to the ISM number, you could see there's a big divergence going on here, and one of these is going to be right. It's either the hard data is going to drag the sentiment up higher, or vice versa. But something's got to give, I feel, Brett. Right?
Yeah. Hold on. Is that a proper comparison?
Is what a proper comparison?
I mean, I guess it is, right? Just to juxtapose those two data series.
I'm not sure what you mean here.
Cyclicals versus defensives, is that
that's the ratio.
I mean, it's correlated well in the past.
Yeah, it's
so
correlated
this
very
is a divergence of significant proportions, and yes, of course, ISM is going to be the cycle, one way or the other, and you see this divergence, and it's either a massive sentiment drinking the Kool-Aid moment that will be healed by some therapy, or it is that how people plan comes from how they feel, and how they feel is going to dictate the hard data.
Yeah, so it's just something that we're going to want to continue to watch and see which.
It's a rare thing. I mean, that's
a rare divergence.
That's a really interesting chart. Look at that.
Yeah,
I mean, that's
very big divergence there.
Unless there's some new components.
It's possible. It's certainly possible.
I mean, it's not a defined series, right?
Into it, but I just jumped off the page to me how much of a divergence this was.
Yeah, as long as it's not been a change in definition, which of course they would have to reveal. Like if what they categorize as cyclicals now.
I can't imagine there has been
some new factor or something.
It's not like you got the rebalancing in the financials where you're getting Visa and MasterCard taken out of tech and moved into financials,
exactly.
right?
Yeah,
so it's not like you.
Although the economy is changing in fundamental ways right now, so
true.
Which means definition could stay the same and the relationship changes.
Yeah. All right. Jumping back to the Fed here real quick, then let's just kind of go through some of the highlights. We've talked a lot about it, but they raised 25 basis points as expected. Powell, or they did change the name to ongoing increases from there to some additional policy firming, which lowered the terminal rate expectations. Terminal rate was actually unchanged. Dot plots and Fed Funds futures trajectory suggest possible rate cuts in 2024. Nearly all participants saw risk to the GDP growth weighted to the downside. Powell noted recent bank issues have helped the tightening process. Pretty much discussed all these. Fed did entertain a pause. Was ready to go at 50 as we know before it. The head scratcher, of course, as we said, was when Powell said that they don't know what happened, which was coupled with Yellen. So we kind of highlighted all that. So anything you wanted to turn back around to on the Fed there, Brett?
Ladies and gentlemen, we don't know what that turbulence was. Actually, we're really not sure what's happened to the plane, so everybody panicked.
Yeah, it was weird. It was a poor performance.
It was surreal, and it was like, so Powell is on a high wire at the circus, and he's declaring that his eyes don't work, and at the same time, Yellen comes out and removes the safety net. Right, that's what we saw basically. Like he's saying, I have no idea where I am or where to step next, and then Yellen comes out and says, and also there's nothing there to catch it. Like it was crazy. Like how does that happen? that
It,
you can
it
confound a
was
moment that
unforced error by the
badly.
two top monetary officials.
It
So
was, yeah, it was
yeah.
such a poor showing at that moment.
But it's unfortunate too because he was doing well, and you can kind of see this with that decline in some rate expectations that we saw. Now going into it, there obviously had been that jump up according to the fund manager surveys. We could see here, people have been moving into the 525 to 55. So this has gotten reversed, and the J.P. Morgan client rate expectations were basically running hand and foot. So we could see the market was definitely leaning for that. So I think they did a good job at reining that in at least. So I
Yeah.
don't think it was all a loss for the Fed, but man,
Well, now what are we
just
thinking? Right? We're
just a
thinking, do you think it's
misstep.
the last hike?
I think that they got another one coming at
You think you got
least.
another one?
Yeah. I mean, it's such a Shea-like moment, I think, for a lot of these central banks hiking into what I think is going to be a recession.
The other possibility is 1972, which I wrote about. We talked about Bank of the Commonwealth goes under in Detroit, and Arthur Burns, I think he was the Fed chair, he stops the hiking cycle. And again, it's 1972. This is the
Yeah, where
beginning of the
the
inflation
auto
crisis.
industry is a bigger industry, so it's not like if it happened today. Where
Right, but it was an inflationary environment for the first time in a long time. Right?
yeah,
It was, the pickup of this new inflationary regime in a way that was intense enough for people to really be worried about. And the Fed was hiking a lot. And the reason the bank went under was the exact same reason Silicon Valley went under, at least on its face, because all of their safe collateral assets had been devalued so hard by the
yeah,
hiking cycle, and that ultimately sunk them. And they had different exposure issues to complement that. So we talk about Silicon Valley, we talk about Bank of the Commonwealth. There's the same thing. There was already a boogeyman there. And then when you put this hole in their balance sheet, people lose confidence and the bank is gone. They did the same thing. They wiped out the shareholders. They wiped out the bondholders. They insured all the deposits all the way up through, outside of FDIC requirements. So same exact situation in a lot of ways. And what happened was Arthur Burns ended the hiking cycle. And 2 years later, we went into just a horrific inflationary depression or inflationary recession. CPI ducked down from 3.8 to 3.2 and then went up to like 9% or something. So it was the liquidity, the stopping the hiking cycle at that point, and really by insuring everything and by putting the Fed's backstop in behind everything. It's kind of a liquidity increasing move at a point when we were heading into the worst inflationary period in, 50 years. So that ended up being the inflection point where inflation reaccelerated.
yeah.
That doesn't mean that's what's going to happen now. There's a lot of differences in the situation, but it's not an impossible outcome. I mean, I think this is, my guess is this is the end of the hiking cycle, but that it sort of could be a pause.
Yeah, I think they'll try to pause going into May, but if all things are going and it's decent Q1 earnings season, they're going another 25 in the next meeting, is what I think.
Certainly.
So we'll see.
But they need this to be a credit crunch to
Yeah,
justify their actions. Like it's
yeah,
predicated on the idea that banks getting much more conservative will be the
right.
financial tightening that they would have done in the
Yeah,
next two meetings.
and we got some credit charts coming up, so hopefully we could get to them.
Okay.
Here's the terminal Fed funds rate. You can see that big dive right around the in terms of expectations, right around the banking issues that
Which is the
arose.
credit crunch taking up that
Right.
slack.
Exactly. Doing the work for the Fed. Here's a 2-10-year inversion, where, we've talked a lot about that big inversion curve. Now, usually when the inversion starts to revert, as you can see back in 2008 and 9,
That's the
back in
recession.
2001, back in 90 through 91, back in 81, that's
Yeah,
the recession. And
that's
that's
the
what we're
recession.
starting to see here right now. So that bears watching, as does the market, which is climbing back nicely here, back up to that
Which makes sense if you
39.85
think
level.
about it. But yeah, you
Yeah,
can.
it makes sense because the end of the tightening's kind of there. So you start getting the front end to drop down.
The front end drops down as things start to
Yeah,
deteriorate.
exactly. So, but we're seeing that
When
roll
they
over here.
drag the safety net back out under the blind tightrope walker.
Exactly. So that's something that we're going to have to continue to watch if that steepens. And here you go, expecting lower short-term rates, where you could see that this is starting to creep back up a little bit on the blue line for the well, that's for the CPI. But you could see that drop off coming down for lower short-term rates. That works into that 2-10-year inversion. An instrument that you might want to have on your radar to play this, SHY. This is the iShares 1 to 3 year T-bond ETF. It's something that I'm looking to buy here at the moment, Brett. So SHY, it's a
Gonna
good way to play
buy
that.
it.
Yeah. Yeah, because I mean, if this is the
Oh, I
value of
see.
the
Now I see.
bond.
I see.
Yeah.
Right. Yeah.
So if
Right.
the yields are going to go down, which I think
No.
that
No.
they
No.
will.
Right. 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 If you're
But
highly
counterparty risk is,
confident in the hard landing, this is the instrument to buy on
yeah,
leverage.
counterparty risk is probably my biggest fear on that. But chart looks pretty good, but a lot of people expecting lower short-term rates here. This is just a chart showing the rate of increase on how fast it's been. Obviously Volcker laughs at this, but even 73, as you're talking about, Brett, had a quicker rate hike cycle than this, but one of the fastest ones out there in the history of the U.S. So this is from Fred and Morgan Stanley. Here's the balance sheet of the Fed.
Wait. Let's digest that last slide. I think it. I mean, I know we got a lot of
Yeah.
slides to go through.
Yeah,
We've already been
I'm
here a
just
long
trying
time.
to.
I just when I spot a slide, I think is really
No, yeah,
interesting.
yeah, definitely.
If we're gonna spend time somewhere, let's spend time there.
Yeah.
So repeat what you just said.
So this is
Fastest.
the third fastest on record. So we had 1980 was faster. It's of course when Volcker just stepped on the necks of everybody there and jacked
No,
up
but
the
there are
rate
points from 0 up, it's the
from
third
0 up.
fastest.
Correct.
But when
Yes.
you look at 1976, the latter part of it
Yes.
is
It went higher for sure.
well, and dramatically accelerated. So there's that
Right.
kind of
But
pause
so
and then go again.
well, you could see in terms of number of weeks. Yes. So I mean, we
Yeah.
could still see 2002 match
Right. We
that.
could see a plateau and then an acceleration. And I mean, you get right. You think you've got it under control. You think the fire is out, and then somebody sees a flame somewhere, and the hose has come back on.
Yes. Which is not out of the question that we get that for sure.
Yeah. Look at just how pathetic 2015 is.
Yeah. Right. I was laughing.
It's just it's got some serious rate envy problems.
Yeah, there's definitely not a lot of conviction in that rate cycle. We could say, leave it at
This
that.
is a sad cycle.
But it is an amazing chart. I thought it was pretty interesting.
Yeah, I think it's
an
extraordinary.
And it kind of goes to show, like, the breaking things fast. I mean, clearly,
that's another point.
80,
Yeah,
and
exactly. Where they
2022 are the
stop.
highest ones above that, right?
That's another dimension. Is if you look at the x-axis, how many weeks they go before they stop. Look at 1980.
Yeah. I mean, that was done over 30 weeks.
Right. Gets all the way to the highest base to peak. And 30 weeks and it's done. And then you get the double dip. 1973 is really what I was just talking about with Bank of the Commonwealth.
Yes.
Which sent us into the 1974 inflationary recession.
Right. Which was an even quicker and steeper rate hike than what we see here. So.
Right. And then you have 1967, start of the Vietnam War.
Yeah. So
interesting chart.
Yeah, it's a good one. So, and I'll be able to send out the PowerPoint to anybody who's looking for it. Here's the Fed balance sheet. Chart. Yep, this is the price actions that
hockey stick.
Hockey stick, the infamous hockey stick. So the Fed was quantitative tightening, right, going all the way down. Boom, quantitative easing. However, we're going to show you how this is not money that's going back into the system. So therefore, I think this is one of the things that people are messing up with, Brett. In terms of the buying the long duration assets. They're like, oh, QE is back. Look at what happened with the balance sheet. But
no, you don't need that for the long duration thing. I mean, I think interest rates is enough to describe that. But I mean, I get what you, but otherwise on the same page. People are misinterpreting this.
Yes. So, and here we'll kind of go through that now. Here's M2 money supply, which, we just want to kind of continue to monitor that. You could see some of that money coming out, which is what which is what they're looking for, of course, for a dip down on that. Here's another way of looking at money supply. This is with commercial bank liabilities other than deposits here. It's a 4-week moving average. It's the blue line. And then there's money supply. So this is money that's being dragged out from the system and from those deposits and everything, Brett, right? So you could see that spike up in 2020 where everybody was looking for where can I put my money? And they were all throwing it in deposits. Now you just see
Well,
that
this is
coming up.
just this is credit availability in the future.
Exactly. And that's all getting dragged out now.
Yeah.
Looking at the inflation data here on core services ex housing, you could see a little bit of a dip down going down. You could see how big of a spike it is. So they are starting to win that. This is again some of that credit being pulled out. And of course, this is why I think maybe they got one more, and then I could see that being the top, because this is part of the PAL scene help with credit being drawn out. This we could circle back around at another time and dig deeper into this, because I don't think this is something that you could gloss over. But you can see here, this is a slide from JP Morgan where it basically talks
It's
about
apples to
market
oranges, no
bottoms
matter
and
what you
Fed
want to do.
pivots. Yeah. But we'll come back to that at another point. So we talked a lot about these Bank of America items of interest, a few that we might not have touched upon. Positioning / policy panic suggests 3,800 for holds. And fade rally runs is what they were seeing.
It's the range.
Yeah. And it's totally into the range. Investor sentiment at 20-year lows, 88% saying that they see stagflation. Cash levels at 5.5%. It's well below where they were in October, which, of course, Brett, is the last time we were talking about those extremely bearish sentiments and where we hit.
But 4% is the average.
Where we hit the lows. But yeah,
it's still a lot of ammunition.
Still up, but not at extremes.
You're right.
Fed peak, again, we've been talking about that. 60% expect cuts over the next 12 months. That's the highest since March of 2020.
Well, they've got it now in the Fed funds futures in July. Cut.
Yeah.
Moving way up.
So, yeah, I mean, it's crazy to see that. So, we'll see how that plays out. But there are some of the things coming out from the Bank of America Fund Manager Survey. Here's a few from JP Morgan, their client positioning. 24% was the highest number, and that's in the 20 to 30th percentile. So this goes into your positioning, Brett, here. So any thoughts on this slide?
Well, it's just so hard to sustain a downside movement in an environment that looks like this.
Yeah. And that's exactly what we we've been seeing it across the board.
I mean, look, I'm a natural bearish trader. Like it's sort of like being left-handed and right-handed. I can play the long side well, but it really, when we get an environment where people are overcommitted on the long side, and I think I understand that they're wrong, that's my party right there. That's my jam. And it happens really naturally for me. I see the patterns really well. I can lever way up, and it just turns into, some really terrific times. And that's just because it's easy for me to see that for whatever reason. I don't know. I think there is a left-handedness and right-handedness.
And you got the wind at your sail.
Well, it's natural for me to see. Look, most people are mostly long most of the time. I'm most naturally kind of somebody who says when one side or the other is overly stacked, then the opposite direction is something I can understand well. An unwinding, a pull rather than a push, an unwinding of what's there. And since most people are mostly long most of the time, that would naturally predispose me over time to really be overly sensitive to situations when there's a big downside possibility because people are overly exposed to a speculative situation. So I think that's kind of evolved over the last 25 years for me. And also the first period when I really made a lot was after the dot-com blow up in 2001, 2002, and probably those early experiences are formative. But in a situation where you get this kind of constant exposure situation like this, it's so much more difficult to do that because you've got people who are already positioned for all of that, and it removes that same kind of opportunity. And we keep getting ourselves here in this market over the last few months.
Yeah. So the positioning kind of coming in, client moves, Brett, this builds off of it. Where are you likely to increase or decrease equity exposure over the coming days, weeks? Only 38% said likely to increase exposure. You can see that falls all into that category that we are just talking about, right? So and that also falls into what you're talking about with the AAII, where people don't see a reason to get into the markets here. They're looking for a reason, and this
Sure, 1 out
highlights
of every
that.
5 seeing upside for
Yeah.
weeks.
Okay, so let's go through the crisis characteristics real quick here. Question, of course, is it a possible Minsky moment, which is naturally an area where all things that the market was kind of looking for all of a sudden comes to fruition and really leads us lower. So that's the primary question that we'll be asking.
Okay.
Of course, conditions look set to tighten. Deposit outflows, it's a psychological phenomenon, of course. So that's why these Yellen comments are moving around the market so quickly. Are they or are they not backing it out? Is increased regulation coming? Are we looking at some fully loaded loan ratio where that's going to be higher? That's going to yank out credit, yearly stress tests for smaller institutions, a comprehensive resolution mechanism, which again is that something like the blanket deposit insurance. Uh, is there going to be a focus on certain types of deposits moving forward? These are all things that we'll see how it comes out. Certainly shines light on the bank's unrealized losses on bond holdings as well as concerns of uninsured deposits. Credit more restrictive with the increased chance of recession, of course. Will the Fed FDIC backdrop lead to a reversal of the plummeting M2 that we're just showing about? Or will concurrent fall in velocity of money from a credit crunch offset the increase in the Fed's balance sheet? Meaning what we are just kind of talking about when we saw that pop up of the Fed balance sheet. But again, I want to show you why that's not going to work its way into the economy itself. It's more just to shore up balance sheets. Competition for deposits could be a major negative for the banking industry. We need to start looking at seeing if we're going to see people coming out offering incredible levels of paybacks to bring your deposits on board to them. And if that does happen, that's eventually going to run out of itself. It's what we saw a lot of the times going around the S&L crisis, where they lost all their deposits because they weren't able to keep up and offer the same savings rates as some of the community banks. So you want to be on the lookout to see if people start jacking up their rates, and if they do people start getting worried about those banks as being in trouble, and that's why they're offering it. That's what we saw investors zero in, of course, for Silicon Valley Bank here. The huge illiquidity in the corporate bond market. We showed that corporate bond spread earlier. Regional banks had an advantage over the larger banks because of lower capital requirements and lighter regulation. But again, is that going to get reined in here? Regulators did not anticipate large losses of banks' bond investments. How are they going to look at that? And then we got holdings showing a 620 billion mark-to-market loss at the end of the year after a sharp sell-off. Now that probably is reversed a little bit, but these are some of the chief crisis characteristics that we've been looking at, Brett. Some of the other things that we want to keep an eye out on too. Regulators encourage these investments in the capital rules for banks. Is that going to change? Holdings carry minimal or no credit risk, but plenty of interest risk. So will they be going after the capital levels as the primary problem, Brett, or are they going to take a look at that interest rate risk and look for ways to squelch that? I mean, we see time and time again that regulators always like to fight the last war, right? Um,
Sure.
UK pension fund that crisis came a couple of months ago. Now we're seeing this. Is this just going to be kind of a rolling crisis of mini fires popping up here and there? So that's another aspect of the crisis we'll be looking at. Euro area banks, Brett, they got 720 billion of TLTROs set to mature in 2023. The bulk of that in June. How's that going to impact the Fed's the ECB's tightening here? Do we see a little bit of a tighten up between the Fed and the ECB following the recent action? Use of the Fed support program is that we're watching that, but so far the issues have been in San Fran and New York. Do we see that pop up in other areas of the country? Then depositors and investors lost patience, as we know, is the primary thing. As interest rates rose, savers saw none of the windfall of money here, and then that led them to be pulling out. So do we see banks try to be a little bit more favorable with deposits? I mean, depositors pulled out $1 trillion last year in deposits. So that's going to be something that we'll continue to watch. And then what are the ramifications, Brett? I know you were looking at this, the venture capital chat rooms. It's being likened to them yelling fire in a crowded movie theater here. How does that impact the banks? So, out of all those characteristics, Brett, what things are sticking out to you here in this?
So there's a couple different points. One is is this a Minsky moment thing? So there's a fence that I'm on. In my opinion, the Minsky moment reality is a progression that's I kind of follow sort of Ray Dalio's way that he looks at this, and way back to Robert Prechter with his Elliott wave stuff, but it kind of had this nailed pretty well. There's like an accumulation of toxicity in the system. You go through cycles over time, and you bail things out, and you bail things out, and you bail things out until enough toxicity builds up. And then you get to the end of the ability to do that, and everything collapses. And so it ends up being about like a human lifespan, and there's about a human lifespan between 1929 and 2008. And in between, you've got a bunch of cycles where you can keep building up that vulnerability by protecting the vulnerability by the bailouts until you get to the point where we pass our threshold for being able to protect it, and there's enough toxicity built up that everything falls apart. So according to that model, no, this is not a Minsky moment. We just had that 2008. It's going to be 2070 before we've got it again.
Hopefully.
Yeah, but there is the possibility. So if I want to play devil's advocate with myself, it's like you start to move up balance sheets. You go from, the household and business balance sheet to being, the major financial institution balance sheet. And that's what we had in 2008. I guess you could make the case. That the next balance sheet out, and that we haven't had the Minsky moment yet. The 2008 was just one tier down, and that it's the sovereign debt balance sheet. And you look at what the UK went through. And if people start to lose confidence in, even developed world government bonds like that, I don't think that's going to happen. I'm just saying that's, if I want to play devil's advocate and come up with a sort of science fiction version of finance, it's that you move up balance sheets till you get to that last stage balance sheet. There's nothing bigger than the sovereign balance sheet. And if people start to lose faith in that, it's a different level of Minsky moment. So we stored that up for, generations until we get to the point where people start to say the government is no good, even if it's whatever it's doing. So there's that. My personal opinion is not a Minsky moment.
I'd agree.
We cleaned it out. We're resetting. We've got some PTSD about what happened 15 years ago.
Yeah, I'd see the exact same elements going in, but
yeah. Okay, well, I got a couple of points, but
okay.
Go ahead.
No, you go on.
Okay, so yeah, regulations are going to be the key. You got populist politician environment. I mean, unquestionably, this is going to be a grandstanding point and campaigning point. Clearly, competition for money will happen, and I don't know if that necessarily indicates problems at a particular bank. Like, you could see it as a heuristic for saying this bank is in trouble because now they're increasing the rates they'll pay for deposits because they need that money to make themselves okay. But you could see a bank that's in great shape, that's got the capital, try to say we're going to steal, a whole bunch of depositors for a generation right now because it's vulnerable. It's an asset out in the open. We're going to scoop them up. And so it can just be a marketing strategy, and it depends on your assessment of your ability to retain new depositors. Um, so we already talked about the sovereign balance sheet, and as far as San Francisco, New York, I don't have as good a framework on, but San Francisco, I'd lived there for a while, and my wife is very much tied into the VC world there. And I had a period of my life where I really got to understand those people and understand how things work there on a very deep backroom level. And there was an absolute bubble there for 2 or 3 decades that was absurd. It's absurd that there's geographic boundaries to capitalizing innovation. It's not a natural designation. It was a legacy effect to a time before now. It's ridiculous that this was trapped there. And of course it's going to diffuse out of there. Of course that was a ticking time bomb. Of course having an 800 square foot apartment sell for $3 million in Menlo Park is absurd, because none of that is sustainable in a world where anybody can communicate at any time from anywhere. Like it's ridiculous, but it was muscle memory that created a bubble of absurd ratio realities there. And the blow up of Silicon Valley Bank is something related to that change. This has been a bear market for San Francisco for 8 years. In every possible way. And it's related to, you can't say if you need to start a new company that's in the technology sector that you have to move to San Francisco or Menlo Park or Palo Alto or San Jose or wherever. That's a stupid idea. It had to break. And there were deals set up. I know this for a fact. You get your $3 million from Kleiner Perkins or wherever, and they hand you the check and they tell you, go deposit this in Silicon Valley Bank. That is where you're going to go deposit this. And when you do, if you've got your product launch coming up in 8 months, you've got your developers there in your spot in downtown San Francisco in the Mission District, you've got your loft, you've got your everything set up. You've got your people working around the clock, ordering pizza at 3:00 in the morning and banging this out. And if you get to where you need a month of leeway, you go to Silicon Valley Bank, you talk to Mark. Mark is going to give us a call and you're going to get a bridge loan. And that's how it works. And they're going to give us that because they want us to make sure that we're steering our next investment to Silicon Valley Bank. And that's how that works there. It was a very, very established thing. And when and there's another point to make here about this, which is if you have interest rates that go from 4% to 0%, like we saw 15 years ago, the reality changes for big family offices controlling hundreds of billions of dollars. They're going to be able to make a certain amount of money. They can't make it anymore on any fixed income, and they go to a barbell strategy. One part of that barbell strategy is to say, we're going to take 20% of this money and we're going to put it at Andreessen Horowitz or Kleiner Perkins or Sequoia or whatever, because, we need them to get us that 100% gain on some of that money so that we can get a 1% gain on the rest of it. And we're still going to end up in a good spot. And if you look at any of these big VCs, their assets under management went up by 20, 30, 40, 50 times after 2008 when interest rates were at 0. And now we're seeing interest rates come back up. And I look at the assets under management. I don't see any record of it coming back out, but man, I guarantee you it is. Like that they're seeing. They have to be seeing, like, the evidence of seeing that AUM dive is in Silicon Valley Bank blowing up.
Yeah.
It is these big VCs that had gone from being, $300 million to being, $18 billion in the last decade. And now interest rates are headed the other way. And that money is coming back out. And their assets are not the same. They're not writing the same big checks.
What about the aspect of, because I know I was talking with my neighbor, he works in a lot of software startups, and he just kind of jumps around, takes a company, works there 3-4 years, gets them off the ground, launches the products for them, and does all that. He took over
He's a programmer.
He's a program, exactly, and he took over for a company, and he was sitting there, and he was taking over for the CFO and COO as well, and he was just getting emails about get your money out of Silicon Valley Bank now. Like it was this whole VC chat room. Do you think that there's going to be any way to, because you look at the crisis and the ability for a bank run to start by somebody sitting at their desk and just typing away, this bank's going under, get your money out now. It's greatly increased. And, it's something you got to figure. Russian actors, Chinese actors, whoever, they're going to be taking full advantage of that. Do you see any way of that being able to be squashed off?
I think that the fact that I would imagine, I think there's a little more complexity to that. After our conversation the other day, I gave this a little more thought. And I think that if you can verify who that information is coming from, is going to have a dramatic difference on how its impact. And I think that if you've just got some random person that nobody knows who they are saying something like that, probably it's not going to spark something like that.
Right.
And it's the fact that people saw enough signals to know that it's like Mark Andreessen saying it, and that's it. Or what's his face, Thiel, like he was clearly saying that. And the fact that people can get a sense that that information is coming from one of these masters of the universe in Silicon Valley, that's going to set off that process. And it's just crazy to just stand there yelling fire in the movie theater. But I think that probably there is enough. I mean, I'm not saying that social media is any intelligence, but that to some extent, I think that the fact that you can verify the source and the fact that it's somebody that people realize have some insight there was really the culprit.
Okay. So we'll fly through some of these others, and we could jump back on at another point and go through these slides in a little bit more depth. But just I know we're running on about 100 minutes here. So the response, here's some of the items that they've done. A lot of going back to the old playbook, Brett, with swaps with global banks going in, the new lending facility for non-depository institutions at BTFP, which speaking of which, stage 4.1 just came out here. So we'll be reviewing that for tomorrow. Yellen, of course, with are they or are they not backing the deposits? That's going to be a big question. Treasury Department does have an exchange stabilization fund that they could use. It's typically used for currencies and financing foreign governments, but so they do have some levers at the Treasury Department too. They placed SIVB and SBNY in a receivership. There's also a network, Brett, out there, 3,000 banks that can provide up to 150 million of FDIC insurance per depositor.
Hammock.
So, what's that?
Hammock warning.
Hammock warning, right? So that's just out there just in case.
So that's eliminated. Yeah, but right, you have a banking crisis while that remains viable, or you don't until that's no longer viable.
Yeah.
But people are willing to be counterparties. Yeah.
Exactly. So once that counterparty goes, then that falls through. Agreed.
Which is going to be an assessment of the genuine risk, and it's a great system.
There was some reports about Biden asking Warren Buffett for an investment in one of the regional banks, harking back to the Goldman Sachs
great brand
trade from 2008. Yep.
Great brand. You bring in the brands right now.
The Credit Suisse bailout was interesting because I still can't believe that they made some of the shareholders whole before the CoCo debt holders. CoCo debt, that was the bail-in bonds from back in the great financial crisis that people could use in order to fill capital gaps. They could just put them out at a cheap level and get paid, but they just ditched the entire 17 billion of CoCo bonds for Credit Suisse. Now, I did see ECB officials come out saying that would no longer be the case, that these bonds were still good. But I mean, talk about shooting yourself in the foot with that move to make the shareholders whole. That was terrible,
right? Because the next time you're going to need to do this, you're setting a
terrible precedence.
Terrible.
Yeah. And then of course we saw the coalition of banks helping out First Republic there. So there's some of the things that we've seen in response. And again, we'll circle back around and dive into it, but I just want to kind of fly through some of these slides. Now, this was from the last H4 where you can just get an idea. The Fed injected about $440 billion into the banking system. We saw the impact on the
You didn't let me
reserves.
do my Trichet accent.
Well, I'm sorry. Do the one compass, Trichet.
We have a single needle compass. We need to, we have single needle.
It's so funny seeing names like Trichet and
I know, it's
Beauvais
amazing.
coming back.
It really brings back the good old
It
days.
really does, doesn't it? So the Fed injected $440 billion into the banking system. Fed facilities took up just over $300 billion. U.S. banks borrowed about $250 billion of the FHLB. Paper appears to have been absorbed by all the money market funds there. So basically, the banks borrowed it, and the money market funds basically were the ones selling all that paper. $500 billion of deposits moved from smaller banks and regional banks to larger banks and money market funds. So you're just wondering about that money market fund issue. Lent depository institutions, the Fed lent depository institutions $308 billion, up $303 billion from the prior week. So you could see how much banks were going there. $153 billion was primary credit through the discount window.
But again, again, I just want to bring it up again for people. This is interesting to look at that juxtaposed with the debt spread, to see there's that much panic for money, and that we're not seeing the panic between the banks. It's a hugely, it's a really positive signal.
Right. And $143 billion in loans to bridge banks FDIC created for Silicon Valley and SBNY. So that's only a temporary item, just to kind of until they got things under control. Only $12 billion was lent through that bank term funding program, and that's more permanent credit. So,
and that's anonymous, right?
Yes. Yeah.
Which
we'll find out in 2 years.
It's not about stigma. Yeah.
We'll find out.
Unless, you find out in 2 years who did it, though.
Yes.
That's
yes.
not that.
2 years.
That's still a little stigma.
Yeah, so that's more permanent credit. But again, that points to these reserves not really transmitting into the real economy. This is not QE coming in. So, be aware of that. This is just kind of bridging funding for these banks. So that's a key thing to watch.
Of course, you could look at it as that it ups their ability to generate new credit.
True.
So if they can't do that without this money, then you add this money and then they can.
Yeah. Yeah, but we're going to get into that because there's definitely some tighter credit out there. So data to watch again. We talked about banks increasing their deposit rates, inflows into money market funds. We'll be watching that. The Federal Home Loan Banks, the FHLBs, the daily issuance. So we're watching that. Just that spiked to $180 billion on the previous Monday. That compares to $400 to $600 billion per year from 2019 to 2022. So that kind of gives you an idea of how much money was just thrown in there. We'll be watching that H41, which was released here. We'll be circling back to that just to kind of track that BTFP there. So there are some of the data points that we'll be watching moving forward. Here gives you a visual of that Fed borrowing window, Brett. And you could see, this is above even the 2008 through 10.
Yeah, and again, without the TED spread widening.
Without the TED spread widening.
If you look at 2008, the TED spread looked exactly like what you see there.
Yeah.
Exactly like it. Like it was people panicking for money to make their institutions be able to survive, and at the same time panicking about the viability of anybody else they had to do business with in the banking system.
Yeah, it's a key distinction.
Enormous. So the hammock is not breaking. People are shoring it up. So this money is coming in, and it's making the banks more whole without them losing faith in each other.
And importantly, without them
healing.
Importantly, without them putting it into the real economy, which keeps inflation tapped out.
Start lending like crazy. But right. But I mean, so presumably there's going to be a reduction in credit because of the more conservative paradigm that would likely take hold after banks face their own extinction. But still, if you're looking for a banking crisis like 2008, if you see this, but you don't see the TED spread take off, what you're seeing is healing rather than panic.
Yeah. So now the key is going to be what all this credit information. What's the impact on lending? BlackRock sees this week's events crimping bank lending, reinforcing its recession view. Credit availability declining for a large swath of the economy, and we'll show you some of those numbers in a second. Ongoing pressure for banks to raise deposits and cope with unrealized losses in investment portfolios will constrain bank lending. We'll be seeing a lot of that, I think, around earnings season. Goldman noted elevated risk of contraction and credit extension in the real economy, given smaller banks. Those less than 250 billion account for 50% of C&I loans, commercial and industrial loans, 60% of residential lending. Again, these are the small institutions, 45% of consumer loans, and 80% of commercial real estate lending came from smaller banks. So that's all going to get contracted. That's why you're seeing these Varenatos of the world, these SL.
But if the Fed were going to raise by another, let's say 1.25, and now they're not, there's a balance there.
Yeah.
Right. If they're now, obviously, are they going to stick the landing? Probably not. But still, the idea being that there's these two forces that are in opposition with one another, that because the Fed can make the same determination, because they see that exact same bullet point, they're then not going to do as much hiking. Right. There's a two waves
which
running into each other.
Which works into that high terminal rate being hit, right? So
yeah. Right.
So again, this is
the
where
tightening. This is the tightening.
This is the assist that Powell is looking for. Goldman Sachs projected if small banks reduce their lending by 40%, mid caps by about 15%, and large caps do not change their behavior, that's going to be a 2.5% drag on 2023 GDP.
That's a lot.
Yes. So here's the growth impacted. This is the FRB senior offices survey, bank tightening C&I loans, and the real GDP. You could see that tightening's dropped, real GDP stays elevated. So that's probably going to drop down. This is from Morgan Stanley. Loan growth slowing. You could see the weekly change in small bank lending by channel here: residential real estate, commercial, C&I loans, consumer, all dipping down here. This is going to choke off the economy. This is why, Brett, I think that earnings slide that we were talking about before, that's behind the ball, and that's going to drop down.
I've commented on complimenting other slides, and you didn't make the slide, so this is not about you. But man, this is a terrible chart. Like what good is this without 20 years of data?
Yeah. No,
coming into other pivots and what?
Yeah.
This is nothing.
That.
There's no information happening.
But
if the information happening, we can see previous cycles.
The lending's pulling back.
It's pulling back, but we want to see previous cycles. My brain is hurting looking at this. Tell me what this looked like in 2015, in 2007, in 2001.
Fair enough. I'll see if I can get that data next time.
My brain is hurting until you do.
So banks with less than 250 billion. This is just a visual of where the C&I loan lending goes, right? So you could see that a lot of small banks are involved in that. Here's commercial real estate. And on top of that, approximately 270 billion in commercial mortgages held by banks are set to expire this year. That's the highest.
This is a structural data point we're talking about. To me, this is fundamentally different.
And don't forget, they have to restructure this at a much higher rate too.
Oh yeah.
CRE
loans. It's a train wreck.
Yeah, train wreck in the CRE. Here's the residential lending, about 60% of that. And then here's some deposit data here. So we talked about the Fed injection here. Goldman Sachs estimates that the program allows for 427 billion of eligible collateral to be posted across regional banks and adds about 25% to bank liquidity. So that's what this was all about: the bank liquidity, not economic liquidity. So 47% of system-wide deposits sit with the 6 largest banks. That's banks above 700 billion in assets, the SIFI banks. 18% of deposits sit in banks, those mid-size, around 250 to 700 billion. 35% with banks below 250 billion in assets, and then 49% are FDIC insured. So again, when you're just kind of looking at the deposits, you can see where all the lending's going in the smaller banks, but the deposits are in the big banks, right? So that's a problem. That's a mix that needs to be situated here, Brett. So Commercial deposits, they're about 47% of overall of all these deposits, and they average a balance of about 1 million. So if you're looking for a number for the FDIC to get to secure, I would be having that 1 million number on the list, Brett, based around that.
I'd be having the number that is whatever needs to be the number.
Yeah, probably, right?
Moment to moment, and when like whatever happens, because it's not systemic. It's just, it could be that way. It could be the nightmare if you don't deal with it. But this is one where you could win with the shock and awe, to me.
Right.
Like,
Yeah.
you could win with the shock and awe here. Like, they're going to do that. Whatever happens next, they're going to deal with it in that way. They're going to be like, we're going to shore up absolutely everything with this one. And you want to try to take down another one, we're going to do the same daggum thing. Like, there, if you, this is one where you can win with a shock and awe.
Yeah. So, and then estimates of 20 to 25% of deposits are large corporate. And why that's important is these are the deposits that can move around pretty quickly here. So it just kind of gives you an idea of some of the backdrop there. Here's the breakdown of the deposits, total amounts. You can see that all broken down by the different institutions. And again, with all the deposits in one area and all the lending in the other, that's the square peg that they got to figure out. Here's just the regional banks and how quickly they grew. You could see the ones at the top: Silicon Valley up 177%, Signature Bank up 164, First Republic up 85%. Far and away the
Over what
biggest
time
ones
period?
there.
What do we
This would have been over a 1 year time frame.
The past year?
No, from fourth quarter 2019 to first quarter 2022.
Right.
So
course
that's
it
the
was.
growth in those.
Yeah.
Right. So
Out of
right
hand.
when all that free money started coming in.
Oh, out of hand. Yeah. And it went to speculative investments with interest rates at nothing.
Exactly. And then people, people were sticking the money in deposits because, where else were they going to spend it when they were sitting at home?
Yeah, but it went to bridge loans to startups that had no future.
Yeah.
Like crazy.
Yeah. Only so much you could put into home improvement.
Come
I suppose,
on. It was
right?
the app to find a bathroom any moment. And, it's going to be the next $1 billion company.
Yeah.
And yeah, of course, here's a $600,000 bridge
But-
loan with a 1 month time
Right.
horizon. And, yeah.
But if you're looking at the regional banks, this is a good chart to go off of. Here's just kind
two of them are San Francisco.
and two of them are San
Two of the
Francisco.
top three.
Exactly.
I'm just saying.
Here's
Bubble.
a breakdown of financial ratios for available for sale and hold to maturities from the money center and regionals. So, again, this is just on here for you to be able to break down. I'll be talking a lot about these throughout all of earnings season. Potential bank oversights that could come. ISI Evercore sees the bank oversight lowering our return on equity by 10 to 15% for these banks. So this is why I think they're going to be a little bit of dead money for a while too, Brett, until we get more of this.
Absolutely.
Bank stock buyback activity, that's going to be muted.
But also just, look at the political situation. You're going to have, Elizabeth Warren-ish populist kind of, both sides of the aisle stepping up, like, I'm going to be the hero. I'm going to hold these banks responsible. We saw it after 2008, right? Like people doing campaign roadshows basically to say, I am going to stand up to these greedy bankers for you. And then, like, you're walking right into it here. You're giving them that. And it's going to be pretty brutal.
Right. And, people are going to be looking at a few different things. I mean, that buybacks are off the table. If they look at held to maturity losses closer, that's going to impact some of the bigger institutions. If you got to, it's kind of the argument around the wealth tax, right? It's like,
and it's a horseshoe, right? I mean, you sent me that article, Rick Scott and Elizabeth Warren teaming up to crack down.
Both of them going after.
I mean, come on. How do you get Rick Scott and Elizabeth Warren working together?
Yeah, exactly. That's how crazy this is and how much broad-based support there is. And then there's the Fed supervisory performance. That's going to be in focus, which, the Fed escaped it during the great financial crisis.
Gosh.
But
it's the biggest thing.
But the idea of 18 people controlling the global economy, I think that comes to an end here. So, the Fed, you can't fight the Fed. Maybe you might be able to fight it in a couple of months.
That's
So
good. That's good.
so that's going to be something. And then just some notes on it. We already talked about the cocoa bonds for Credit Suisse, which is definitely going to be a story we'll want to watch. And then just a breakdown of some of the characteristics for First Republic here, Silicon Valley, Signature Bank in New York. You know, whether or not JP Morgan clients, 55% thought that was idiosyncratic. So we'll see. That's another thing that I don't think's been priced in. Is this more of a broader scenario going around to some of the different banks? You know, we'll get a better idea of that in the coming weeks and months. I think that this is going to be a rolling issue going on. And then, of course, not a surprise seeing the banks money rolling out from the banks to tech, right? Which is kind of funny considering a lot of the tech companies are to kind of blame for what's going on. I suppose you could argue in terms of VC capital and stuff. Um, and then, you know, hedge fund bank exposure, you know, everyone is leaving that. Money center valuations. And we are going to make this available. You know, if anybody writes in, we'll be able to send this off.
Yeah,
So
we're kind of breezing past stuff, but we can send it to you.
yeah, just for time constraints. We knew this was going to be a long one, but
Big one, beast.
money center banks, the price to tangible value is coming on here. Here's the regional bank valuation. So that's all in the back here. Regional bank balance sheets, some things to keep an eye out on. This is what we'll be watching. Here's a breakdown of their deposits and you know, mortgage-backed securities and treasuries. So a helpful chart there for tracking these institutions. Just large for a small balance sheet with a look at time deposits. And then finally, regional banks. They don't have a big share in the investment grade market for what it's worth. So that does it for this beast of a presentation, Brett. So you know, we're just going to close up here. Real quick, Fed loans to FDIC bridge banks rose by 179 billion from 142 billion. So that was way up. The bank term funding loans, Brett, that spiked to 53 billion from 12 billion. And the Fed discount window loans falls to 110 billion from 152 billion. So a lot more people going into that BTFP.
Can you repeat that
here.
whole last several sentences?
The FDIC bridge banks, they rose to 179 billion from 142 billion. So that would be temporary lending, just you know, in order to
Rose
roll
a lot.
over that. Yeah, rose a lot. So people are still using this facility, which suggests that the banking facilities aren't working properly. The bank term funding loans rose to 53 billion from 11 billion. So that's a little bit more permanent credit there that people want to hold on. They don't want to keep accessing this on the other window on a weekly basis. Then the Fed discount window loans, they fell to 110 billion from 152 billion. So really, people that were going to the discount window seem to be going for the bank term funding loan.
Still good sign again without the
yes,
yeah.
So there's nothing overly concerning here, I would say, but just kind of a look at this. Things aren't the circulatory system isn't working perfectly here. So
right,
but
you also have a sense that like humans broadly in whatever place they live in, whatever industry they're in, are scared right now financially.
Yeah.
And people at banks are human. And so to see that they're not getting to the game theory landscape of a competition framework versus a cooperation framework is the big plus. And the fact that they're shoring up, getting as much capital as they can that's stigma free is a natural response to that shift.
Yeah.
To me.
So yeah, no, I agree. So it's something to watch. To be perfectly honest, I'm just slowly warming up to the data for the H4. So I don't have a perfect grasp on it, but we'll get there as this crisis moves along. So Brett, okay, we've had a lot to say. Why don't you wrap us all up? You do such a good job with the conclusion on where we stand, and then we'll call it a day and let people get back to their lives here.
Well, I think probably, you know, Kevin and I both agree that, you know, aliens are going to invade the solar system and blow the sun up, and that's it. Right?
It's really the only takeaway from this.
I mean, all the rest of this stuff is just sort of pointless because we got that coming at us. No, so I think that we've we've lived in this washing machine for a period of time where we've got endless source of new vulnerabilities that are very apparent, very visible, very forceful on the intellect for people taking part in the financial market ecosystem. And it has had an indelible mark on sentiment and on positioning, and we see lots of different signs of that. And every time we kind of melt down a bit and we get the next version of dominoes falling on that kind of reality, which is all really at the end of the day about, the price of money going up. Like it all goes back to when Gavin and I were talking a year ago or a year and 3 months ago, that you've got this, like, you've had this Fed put and you've had this dividend yield versus interest rates put, been around for a decade and a half, and they're both gone now. They're both just gone. Like the Fed now has to prioritize inflation and fighting inflation, and you're going to see the yield of your risk-free securities go well above the dividend yield for anything on the equity side. And we've lived in a world that wasn't defined by that for a long time. Metaphor that I've used in the past is this sort of mountaintop lake idea, where there's a pond that has no salt in it, and you have a whole ecosystem that develops around it, and suddenly you scoop up all the fish that live there and you throw them into an estuary where there's variable salinity, there's a lot of salt in the water. How well are they going to survive? And money managers in the environment that we've seen over the last year basically have been those fish. They've acclimated to a universe with 0% interest rates on a multi-decade kind of time frame. And a lot of the people controlling the vast majority of money are those fish, are people who have come up in a system that suddenly radically changed, and they're trying to adjust. And there's a lot of things that are gradually breaking on that basis. But more than that, to me, what's been striking personally, and I can't speak for Gavin and I can't speak for anyone else, what's striking to me is how visible so many of these symptoms are, and how hedged and how psychologically prepared everyone seems to be for the inevitable over the waterfall moment. And in my experience, to me, it's so hard to bet on that fall over the waterfall when you have a lot of tangible evidence that shows that, everybody's got their life jackets on. And that there's a lot of risk of the possibility that the waterfall never comes, and everybody's malpositioned for that outcome. So, as I said earlier, the hardest possible trading environment to me is when everybody's bearish and everybody's right. Everybody loses in that situation. It's not the case that people can navigate that well. The moves are too volatile. There's too many landmine squeezes. There's too many headline opportunities to screw everybody who's over leveraged, and just nobody wins in a situation where everybody's bearish and everybody's right. Just nobody wins. And we've been living in that universe in many ways for a series of months now, and that's why we kind of are holding up better than you'd expect. And to me, that's what continues. And I don't see this as a systemic banking crisis. I can't find any way to put my head around it. And there's one tiny percentage window where I'll say devil's advocate to myself on that, and that is what we talked about with the shadow banking system, and whether or not the results of the fund manager survey are intel rather than speculation. And that there's a bunch of people answering that survey who understand that there's a huge vulnerability that's about to start to come to light, and that the interest rate phenomenon that we've seen with the market devaluation of T-bills is going to be the straw that breaks the camel's back, but that ultimately the problem is a much deeper vulnerability that's been built in to the system, and we get a genuine credit crisis. And I think without that, people seem to be looking around the corner, or at least they're going to be forced to look around the corner. They're not, but we've got a lot of cash in portfolios. We've got a lot of hedges, and we've got a lot of short interest. So there's that summary.
All right, no, that's perfect as per usual, Brett. So, from my perspective, just in the grand scheme of things, I see credit tightening up to a point where I see ideas for recession coming into play and just people simply not positioned for it. So, I'm all for riding a wave higher, but I do think sometime within the next 3 to 6 months, we're going to see the rug pulled out from under this market. And I'm not looking for a big crash, but I do think that the October lows will have to be tested at some point. So, we'll continue to monitor this data as it comes out. Like Brett said, when the positioning is the way it is and everybody's looking bearish, you need to get some of them off the sidelines here to drive us up higher. So,
You get to
um,
take the life jackets off.
exactly. So from my perspective, I could see something like a rally, Q1 earnings coming in better than expected, guidance not being too bad, and the market's just blasting off there going up into May. And then you get the sell in May effect, and everyone's like, oh, it's just sell in May. And then all of a sudden you keep breaking down, and then you get a little bit more on the debt ceiling front, and things like that all start working their way
And as I
in.
said, Gavin takes the position that aliens are going to invade the solar system and blow the sun up.
Well,
So, I mean, that happens, and it's really bearish.
yeah,
Which, honestly, that's a bearish
short solar
scenario.
names. Get short solar names in that
Solar is
scenario.
going to implode when
It's all about wind, baby. All
when the
about
sun
wind.
gets sucked into 2 dimensions because of the dimensional bomb. Then, yeah, it's going to be really rough for solars.
Yes. When there's no sun, solar becomes moot.
It's a really tough environment for these guys.
So, all right, Brett. I think we'll let everybody off. I know it was a 2-hour bear of a show today, but we did want it to be comprehensive. We thought about breaking it into 2, and maybe on hindsight we could have, but
But we did it.
But we did it.
I think it's a
So
lot of good stuff. Hopefully, you guys
it's a
enjoyed it.
lot of good information in here. Like I said, I'll be putting together I got to figure out the best way to get out the PowerPoint presentation to people. I know that there's been a few requests for it. So if anybody wants it, definitely feel free to write in to feedback here, and we'll figure out the best way to get it out to people. So, all right, Brett, with that, I'll let you off the hook. Thanks for sitting through this 2-hour
Oh, it was great. Good discussion.
Iditarod
I enjoyed it.
with me here, and great commentary as per usual. And hopefully everybody is a little bit smarter and well aware of what's going on here, and we can build off this and make
Especially
everybody
this
a bunch of
bearish
money.
solar thesis. Yeah.
Yes. Buy the $1 puts for solar, right?
Absolutely.
All right, Brett. I will talk to you later. Everybody out there, have a great evening, and talk to you soon.
Yep. Take care, guys. Take care, Gav.
Bye bye.
Bye bye.